This is really getting serious, guys. Y'all remember Michael Burry? Michael Burry is the guy who made billions off of the back of the financial crisis in 2008 by timing the housing market crash. They even made a movie out of what he did. You guys remember The Big Short? Have you heard of that one? Well, now Michael Burry's predicting the mother of all crashes and the huge market bubble that's about to crash. So what are we supposed to do about that? And the more important question, how are we going to make some money from this news? We'll answer all of that and more in today's video. But before we get going, I just want to give a big old thank you to you guys for always lighting up that like button. Thanks to your likes, your comments, and your shares, we can keep our YouTube lights on and keep you guys informed on all things stimulus and making money. Speaking of, let's get right into it, shall we? All right, so Michael Burry, he's this big investor who timed the housing market. Now, what many people don't know is that he's also made millions by timing the dot-com bubble to a T. From there, he put up a hedge fund that beat the S&P 500 every year until 2009. 2009, that was when he hit his biggest home run, billions of dollars from the financial crisis. Now, he's warning people about his long-standing concerns about the rise of passive investing. He cites a recently released working paper that found the stock market's aggregate value tends to rise by about $5 for every $1 invested. So that means that the stock market's ballooned to ridiculous proportions with all the investors on both Wall Street and Main Street that have essentially been throwing money into passive investment strategies like exchange-traded funds. Burry says, like most bubbles, the longer it goes, the worse the crash will be. The first step is to recognize that the 5-to-1 is not a natural ratio. So what will continue this paradigm? What may reverse it? This is the knife's edge because we are at 5-to-1 ratio. It may go to 100-to-1 or maybe negative 5-to-1, but parabolas don't resolve sideways. He's also warning people about the mother of all crashes that could come from investors throwing their money into cryptocurrencies and meme stocks. And in the second quarter, Burry also made a handful of bets against the ETFs of Cathie Wood's ARK Invest, which are not passively managed. And the biggest sign of them all, according to Burry, the Federal Reserve is misleading investors and America's largest tech companies need to be taken down a peg. Burry slammed the Fed for downplaying the threat of inflation. His tweets have been deleted already, but it said, "So at Federal Reserve, are you lying to us or are you lying to us?" There was also a scandal involving 2 Fed officials trading stocks who've since then already committed to selling their holdings. He tweeted, "Cute timing for the ethics outcry to force Fed governors to sell stocks. Too cute by half." Lastly, he's all about hashtag boycott Amazon and hashtag boycott Facebook on his Twitter, saying, "Boycott big tech, whether a little or a lot, please do, for your health and the health of others." Now, if you guys remember, we've been following the story on Facebook whistleblower Frances Haugen on this. Here's a clip from her recent interview with Congress.
Thank you. I want to pivot back to Instagram's targeting of kids. We all know that they announced a pause, but that reminds me of what they announced when they were going to issue a digital currency. And they got beat up by the U.S. Senate Banking Committee, and they said, never mind. And now they're coming back around, hoping that nobody notices that they are going to try to issue a currency. Now, let's set aside for the moment the sort of the business model, which appears to be gobble up everything, do everything. That's the growth strategy. Do you believe that they're actually going to discontinue Instagram Kids, or are they just waiting for the dust to settle?
I would be sincerely surprised if they do not continue working on Instagram Kids, and I would be amazed if a year from now we don't have this conversation again.
Why?
Facebook understands that if they want to continue to grow, they have to find new users. They have to make sure that the next generation is just as engaged with Instagram as the current one. And the way they'll do that is by making sure that children establish habits before they have good self-regulation.
By hooking kids.
By hooking kids. I would like to emphasize one of the documents that we sent in on problematic use examined the rates of problematic use by age, and that peaked with 14-year-olds. It's just like cigarettes. Teenagers don't have good self-regulation. They say explicitly, I feel bad when I use Instagram, and yet I can't stop. We need to protect the kids.
Just my final question. I have a long list of misstatements, misdirections, and outright lies from the company. I don't have time to read them, but you're as intimate with all of these deceptions as I am. So I will just jump to the end. If you were a member of this panel, would you believe what Facebook is saying?
I would not believe. Facebook has not earned our right to just have blind trust in them. Trust is, last week, one of the most beautiful things that I heard on the committee was trust is earned, and Facebook has not earned our trust.
But what do you guys think here? Should we trust Facebook? Drop a quick comment down below. But you guys get the idea. This big short investor is sounding the alarm on the stock market. In particular, all of this blind trust in tech, plus this crazy big money going into index funds. Now, just to be clear though, the idea that there is an index fund bubble really isn't actually that new. It's been around for a few years now, and it's not too difficult to see why the S&P 500, the most widely invested in index in the world, has been outgrowing the American economy for some time now. Now, if you think about it, if it were any other company growing its revenues, profits, and customer base by 5% every single year, but its share price is growing by 10 every year, it'd only be a matter of time until it comes crashing down due to overvaluation. People are basing all of this on what they call the Buffett indicator, which looks at the companies behind the index. At the peak of the dot-com bubble in the early 2000s, that number was at a dangerous 150. Right now, it's sitting at 239, the highest reading ever. Now, don't get me wrong here. Pretty much everyone, including me, has been putting in about 10% of our paycheck or more each and every single month into the S&P 500 to prepare for retirement. Personally, I love index funds, and I still invest in them. Just tie your investments to the economy. Simple enough, right? The problem comes when too many people do this and no one invests in individual stocks or actively managed funds anymore. What happens is that index funds and the millions of people behind them are not just throwing their money at whatever stock is biggest and pushing its price further. If Michael Burry is right, it's definitely not going to end well if it stays the same. Kind of some scary stuff here. So here are 3 ways that I'm preparing for a stock market crash. All right, so number 1, I'm holding my investments. Now, of course, none of what I'm about to say is investment strategy or investment advice. This is all purely for entertainment purposes. But let's be real here. Stock market crashes are scary. You'll see stocks go blood red. It'll definitely be tempting to sell your stocks when it hits crazy lows. In fact, it can also be tempting to sell them off now so you can buy them cheaper when the crash happens, if the crash happens. The thing is, timing the market is next to impossible for even the most skilled investors. Even if conditions look ideal for a crash or correction, that doesn't mean that it's actually going to happen. Been there, done that, got the t-shirt. Just look back at the crash at the start of the pandemic last year and the bounce back right after. If you sell now, there is a chance that stock prices could keep going up. The key here is to choose investments that you believe will perform well over the long term and that you're confident will be able to survive a downturn. Number 2, make sure that your nest eggs well intact. It's good to have cash on hand rather than just have it all tied up in stocks. Otherwise, you would be facing a headache in selling during a downturn and locking in all your losses. The generally observed safe number is around 6 months worth of savings stashed in an emergency fund. This way, if the market crashes and something unexpectedly expensive happens, there's always that nest egg to draw from. Me personally, I would rather have at least 12 months emergency fund stashed away. Number 3, I'm making a list of potential investments to buy. Now, this is where it gets really exciting. When market downturns and crashes happen, it's a bad time to sell, but it's actually the greatest time to buy. Just take a look at this here. While other people's emotions are going up and down, you can actually take advantage by looking for quality investments for a fraction of the price. It's kind of like when the housing market crashed during 2008, 2009. If you bought property in real estate during 2008, 2009, today, I guarantee you are very, very profitable right now. I'm pretty sure a $150,000 house that was purchased in, say, 2009 is probably worth about $350,000, if not $400,000 today. But think about it, when other people's emotions are going up and down, you can take advantage by looking for quality investments for a fraction of the price. Now, although their prices may be lower, good investments are still good investments, no matter what the market's doing at the time. Strong companies are likely to pull through market downturns, and by investing when prices are lower, you'll reap the reward once the market rebounds. What you need to do to prepare is just to write a good old shopping list of all the stocks that you're interested in before prices fall. Consider it your Black Friday sale on winning stocks. Invest with caution is always what I say, guys. So doing your own research is definitely best here. Now, to get you guys started, here's a quick list of stocks that I'm kind of looking at right now that you may or may not want to add to your stock market crash shopping list. All right, so the first one for me is MasterCard. Could be a safe investment mainly because, the company's strict deals with the processing side of the equation and has resisted the urge to become a lender. While not lending is in theory costing the company opportunity to generate additional income and interest and fee income, it also means that MasterCard has no liability stability when credit delinquencies rise during recessions. Not having to set aside capital to cover losses is a huge reason why the company's profit margin has stayed around 40%. Additionally, a majority of the world's transactions are still being conducted in cash. MasterCard has a long runway with which to push its payments infrastructure into emerging and underbanked regions of the world. Definitely a stock to look into. Next Era Energy. You almost can't get any safer than energy, and Next Era Energy could be a really smart place to put your money if the stock market crash does actually occur. No matter how well or how poorly the stock market or US economy are performing, demand for electricity among homeowners and renters doesn't fluctuate much from year to year. They also focus on renewable energy. These kind of projects may be more expensive in the short term, but they substantially lower electricity generation costs and have lifted the company's compound annual growth rate to the high single digits for more than a decade. In a comparison, most electric utilities have a low single-digit growth rate. Amazon. Who hasn't heard of Amazon, right? When eMarketer released a report in late April examining US online sales market share in 2021, it estimated Amazon would control roughly 40 cents of every $1 spent domestically. Walmart is the second largest online retailer by market share, and Amazon has more than 5 times its share. Amazon's also beefing up its margins with its Amazon Prime subscription service, tens of billions of dollars in revenue each year from that. Not to mention Amazon's less known Amazon Web Services, the most dominant name in cloud infrastructure services. This is important because cloud and subscription services, they offer considerably juicier margins than online retail sales. As a result, these segments could play a key role in more than doubling Amazon's operating cash flow by mid-decade. Now, of course, don't take my word for all this. Take a look yourself and see the best investments for yourself and your particular situation. Now, my best advice, take a look around you and look at all the brands and companies that you've been using in your day-to-day lives. The best investments are really the ones that you know best and have really done the research on. So I hope you guys got all that. That's your 2001 stock market crash prediction, care of Big Short investor Michael Burry, how I personally prepare for an eventual stock market crash. And if you stay ready, you ain't never got to get ready. And lastly, the stocks that you could consider for your stock market crash shopping list. Let me know if you want more information about stocks and the stock market crash. Drop a quick comment down below. Better yet, let me know what you want to learn more about so we can plan our future content together. Until then, we'll keep the stimulus flowing and the money making going. Don't miss any of it. Subscribe to the channel now and hit that notification bell already. And as always, thank you guys so much for tuning in and hitting the like button, and I will see you guys in the next one. Take care and be safe.